For the past 3 months, the world has been pretty much on fire. The stock market fell and rose like a roller coaster, the global economy shut down, and millions of people have been tragically affected by the largest black swan in modern history. The US government has pumped big money into the market via corporate bailouts, small business loans, and personal checks. While the financial stimulus seemed like it couldn't come soon enough, one has to ask, where is all this money coming from? And how will it affect the future of our economy? To answer the question simply, every dollar of the stimulus package, and any stimulus package Congress might pass later on, is borrowed and tacked onto the US national debt, which has already ballooned to $25 trillion. But what are the long term effects of borrowing huge amounts of money like this? Well, for starters, government debt is not like the debt you or I may have on our home, car, or student loans. The government takes on debt by issuing government bonds, which are sort of like IOUs that are then sold to public or private investors. These bonds have interest rates, called the bond's coupon rate, which the government pays to the investors for holding the bonds. Because these bonds have their value guaranteed by the US government, they are considered a very safe investment. But this doesn't explain how the government was able to make trillions of dollars appear seemingly out of thin air. Well, remember those bonds we were talking about? The investor who bought trillions of dollars worth of government debt in this case was the Federal Reserve, also known as the Central Bank of the United States. Where did the Federal Reserve get this money? Now imagine this. Say you're looking at your checking account and it has $1,000 in it. Now you snap your fingers and your account has $2,000 in it. Yeah, that's how the Federal Reserve works. The Fed has a fancier term for printing money called quantitative easing. Quantitative easing works by allowing the Fed to purchase assets like Treasury bonds, corporate bonds, and mortgage backed securities. This is usually done by increasing the balance in the reserves of major banks so they can lend out money at lower interest rates, which encourages people to borrow more money and stimulates the economy overall. Now I know what you're thinking. Won't all this pulling money out of a hat stuff cause rapid hyperinflation? Well, hyperinflation is defined as a currency losing 50% of its value a month over a period of time. For reference, let's say you can currently buy a gallon of milk for $3 at your local grocery store. At 50% inflation every month, 2 years later, the price of the same gallon of milk would be a whopping $50,502.34. This is certainly a little scary to think about, but luckily we have some historical models that we can study to make sure we don't go down the same path. It's highly doubtful that the US will print sums of money enormous enough to completely tank the value of the dollar, and while increasing the money supply certainly causes some inflation, it can be controlled so that it doesn't get out of hand. We can't predict inflation or hedge against it with certainty, but the latest historical model we have for quantitative easing was the 2008 financial crisis, in which the Federal Reserve implemented a $700 billion bailout for the big banks. This increased inflation by just about 4%, which soon stabilized. In fact, the past 20 years have seen stable inflation at around 2% per year. The long-term economic effects of the pandemic have yet to be fully realized. While the stimulus package that already passed signifies an unprecedented injection of money into the economy, it is unlikely to cause inflation similar to what the world has seen in Venezuela or Weimar Germany. But the Fed's promise that they could end up buying unlimited government debt certainly is a little troubling. Thank you for watching this episode of Brain Food. Please like the video and subscribe to the channel if you want to see more videos like this one. I'll be making videos about economics, finance, and technology, and just things that interest me about what's happening in the world. So if you're interested in that kind of stuff, be sure to subscribe so you don't miss out.